Welcome to Booked, the bookstore education podcast brought to you by the American Booksellers Association. In today's episode, we're looking into key takeaways from the most recent ABACUS financial benchmarking report, covering 2023 financial results from independent bookstores around the country.
Thank you for coming to ABACUS takeaway session for 2023. My name is P.K. Sindwani. I'm the CFO for American Booksellers Association. I have with me Anna Gonzalez, who's also with ABA, County Coordinator, Senior County Coordinator. And then we have a special guest today, Greg Mounts of Industry Insight. Just to give you a background, ABA only organizes and sends all the communication, but all the data is compiled by Industry Insight. And Greg is in charge of collecting and analyzing all the data. I don't see that Industry Insight gets all the data and they see. So I'm going to have Greg take it from here and go through the numbers for this year.
Sure. Thanks, PK, and thanks everyone for joining us here this afternoon. Let me see if there we go. So yeah, just a little bit about Industry Insights. As PK were saying, we're an objective, kind of independent third party that's maintains the confidentiality of the data. We're a group of statisticians, CPAs, economists, and IT professionals. So naturally, we're the life of every party. We focus exclusively on survey-based research. It's not an offshoot of our core business. We've been serving the informational needs of associations and their members exclusively since 1980. Again, it is our core business. As PK had mentioned, the ABACUS survey, it's an online confidential survey conducted by us as the objective third party, maintaining the confidentiality of that data. None of the data is shared outside of Industry Insights. And as I mentioned, we do this for all different these types of studies for all different kinds of associations. The results of the study are housed in the ABA or ABACUS research portal. The link that can kind of easy to remember to get there is just abacusbenchmarking.com. We have a really robust sample that we're working with each year. PK and Ann and I were actually just talking about that right before we got on here. Data tends to normalize around 30 responses, but the confidence intervals when you're doing a purely random sample, 385 is kind of that magic number. But with 468 organizations, this is a really robust data set that we're working with, and the results are very confident and very pleased with the results of the study each year. The culmination of the survey is obviously the core financial benchmarking report, the ABACUS report itself, which is a PDF-based report. But I also would just want to highlight the additional features that you receive as a participant that are invaluable as you're analyzing the results. The detailed Excel data tables have much more data aggregations than what we can easily include in a nice, easily digestible PDF-based report. Hopefully, if we have a little bit of time after this PowerPoint, we can kind of step through the actual Excel file and kind of show some of the additional data aggregations that are I think are very useful in the detailed Excel data tables. The other thing you receive is a customized company performance report that puts your information right alongside those comparison groups that are most applicable to you, as well as the most profitable data group, that allows you to compare yourself to that most profitable group to see kind of where the variations are between your results and theirs. the interactive report card feature that we'll touch on here momentarily, what it entails, and then searchable results that allows you to filter the results kind of by multivariable, easy for me to say, multivariable analysis, where you're looking at sales volume and regions possibly, and kind of merging those two together to look at the data to drill down a little bit further in the results. The report card feature, as I mentioned, I like to touch on it because I feel like in this day of shrinking attention spans, this is the one thing that allows you to very quickly identify, based on 20 to 30 key metrics, how you're performing versus whatever comparison group you decide to choose to compare yourself against. This example that I did, I selected comparing it against the most profitable, and this is all just a fictitious company, but let me see if I can get a pointer here so I can at least kind of show you what I'm referring to. But the key here is that it gives you your firm's information right alongside the industry comparison, and then gives you a grade how you fared against the industry comparison group, whether you're weak, fair, good, or strong. And kind of to take that one step further to explain a little bit what we mean by that, but the lowest 25% of the figures, if you're organizing the data from the smallest figure to the highest figure reported and slicing it into 4 quartiles, you would have the lowest 25% would be up to the lower quartile figure. The median is the exact midpoint. 50% of the respondents report above that figure, 50% below that figure. And then the upper quartile figure is where 25% of the respondents reported a figure higher than that particular measure. And as you kind of see here, these 25% buckets are how we line up those grades, if you will, whether it's a weak, fair, good, or strong, and based on the results. So I always like to touch on this, and especially it takes on more meaning here as of late. Historically, it used to be, heading up to 2020, really kind of almost pre-COVID, inflation was more or less in a nice, very small, light range of 2%-ish for about 20 years or more. But once we have the inflationary environment that we've been in since 2022 to 2023, kind of the peak time where we are seeing peak inflation, it's more important than ever to keep that in mind when you're looking at any kind of a metric that is just dollars. So, for example, I always use this very rudimentary but simplistic example of if you told me that 2 companies both had $1 million in profits, it really doesn't tell me anything about them other than they had $1 million in profits. If you look at it a little bit further and tell me what their actual sales were, it paints a whole different picture when we take those as a ratio and look at the profit margin of one being at only 5% margin and the other one being 13% margin. So it really emphasizes again the importance of looking at figures as ratios, because it does sort of create that common platform for reviewing information that you're basing decisions on. And then ultimately, you have to compare those ratios to something, comparing it to your own historical performance, your own budgets, or in the case of the ABACUS, like we're doing here, looking at your industry peers and how you're performing relative to the rest of the industry. So what metrics are the most important? When we at Industry Insights, when we look at companies to evaluate their financial performance and overall financial health, we look at 5 key areas. We look at sales growth, sales is obviously the lifeblood of any business. Without sales, you're not going to ever be profitable. Whether you can manage your expenses as well as possible, but without that top line sales, you're no amount of expense management is going to create profits. Um, but next, we do look at the profits, look at that kind of expense management and how it relates to your bottom line. Then we look at assets and debt and kind of get an idea of the overall financial health of your organization. We don't capture a lot of that information in the abacus, but your accountants definitely will have that information. And we'll kind of step through some things here later, just to give you an idea of some things you might want to at least review with your accountant. And then lastly, often referred to as our greatest asset is our people, our employees, and how we manage our employees and manage the expenses related to them, or investments, if you kind of look at it from that perspective, as an investment in your staff. So starting at that top, we kind of take a top-down approach. We look at the sales growth, look at overall sales, as the industry, and looking at your metrics relative to the industry. Overall sales growth that Abacus was collecting data, from last year. So this is 2023 versus 2022 performance. Having 8% sales overall top line sales growth is still pretty strong. The latter part of 2023, we started to see a little bit of a disinflationary environment. So still being able to maintain that sales growth versus 2022, which was a very high inflationary environment, is certainly encouraging to see. And as you might imagine, as the stores get bigger, it's a little bit more difficult to grow the top line revenue as you have a much larger denominator there for the prior year comparison group. It certainly is a little more challenging to get some of these larger, robust sales growth figures that some of the smaller stores had. Sales per location, as you'd imagine, our buckets that we're looking at, less than 250,000 to 500,000. We've got that nice linear curve there, ramp up in terms of the total sales per store or per location here, across the various breaks. Sales per square foot of selling space is another metric, just from a productivity standpoint, to think about when you're looking at your evaluating your overall sales productivity. Again, as we start to see some of the larger stores in terms of revenue, they are also creating much more revenue per selling square foot as well. The profits, it's the summary income statement, kind of as we're getting into the profitability area. I like to focus on this, even though I made the comment that you've got to have that sales growth and sales in order to improve the bottom line. But there is expense management. It is critical. Every year, and in reality, almost every study that we do, the most profitable data break are almost always much better across the board in terms of their overall expense management categories. Looking at the expense management from personnel expense, occupancy expense, and then your all other operating expenses, they're significantly better than the general groups as a whole, in terms of their total operating expenses that they're incurring. And it's certainly reflective in the bottom line net profit before taxes. So taking that one step further, just looking at the gross profit, obviously the gross profit margin is critical piece to manage. I don't have it here, but we do have the breakdown by gross profit for for books in particular and non-book sales as well. Just keeping those an eye on those and monitoring those gross margins across each of those larger scale categories, and certainly looking to drill down into those where you might see that there is a variation from your numbers versus the industry numbers is certainly a critical piece to continue to monitor. Total operating expenses as a percentage of net sales, as I mentioned in the couple slides prior, the most profitable group certainly had a pretty significant advantage in terms of how they were managing their overall total operating expenses. Some of those are controllable. Some of those are a bit of a challenge to control. We certainly understand that. Occupancy expense is certainly one of those larger categories that can contribute to that sometimes you're somewhat at the mercy of where your location is and where you're located, the occupancy expenses that you might have to incur. Net operating profit as a percentage of net sales, obviously, as we can see here, quite a bit of variation across the board. 2023 was certainly a much more challenging operating environment than 2022, where we had much higher metrics or percentages of operating profit as a percentage of net sales in 2022. So the assets and debt, as I mentioned, some of this information we don't necessarily get into in great detail in the ABACUS study. In particular, the debt ratios, I want to encourage you to at least get in the habit of discussing the debt ratios and asset productivity with your accountants. In particular, if you happen to own your building or own your location, there's certainly more critical to kind of keep an eye on this as you manage your overall financial health of your organization. Liquidity is another thing, just in terms of managing your current assets or current ratio or quick ratios are two metrics that give you an idea of, okay, based on your current assets you have, being current assets or your cash, your accounts receivable, which typically don't have a whole bunch in this industry, but cash and your inventory as well, and how quick those can be converted to be able to pay off current liabilities, accounts payable, those kind of short-term liabilities that are required. The number one thing being your cash cycle, kind of keeping an idea of, okay, the number of days in inventory, number of days that you have in your payables, and then adding back your days in receivables is what gives you your cash cycle, and which a lot of you are dealing with in terms of managing, okay, keeping how much inventory to keep on hand. Buying the inventory is what goes into that days and payables, and that cycle in terms of how quick you're outlaying cash to buy the inventory, and then how quick you're getting that turned back into an actual sale and actual cash cash received. So on average, typical is we had about 79 days. In terms of taking the days in inventory minus the days in payables, and then more often than not, days in receivables are essentially zero for this industry. So again, the average days in inventory, as you might imagine, some of the smaller companies or smaller stores are going to have those longer cycles in terms of when they're turning their inventory versus the larger stores. And accounts payable days, kind of almost the inverse. The smaller stores may not have as favorable of terms with the publishers in terms of buying the inventory, that they've got to pay a little more quickly. So you have those shorter days, accounts payable days cycles, than some of the larger firms where you're getting, almost 58 to 60 days plus in terms of accounts payable days. So again, there's,
Sorry, Greg.
yeah, go ahead.
There's a question in there.
Yeah.
When you're talking about average days in inventory, what are you talking? Turns? Did you see that?
1 second. Yeah, I'm trying to read it here. So average days inventory. So it's essentially those two metrics kind of go hand in hand. So the inventory turns, if you think of it, are essentially, if you took 365 divided by the number of turns, it's going to give you the inventory days. Okay. So did you have something else, PK?
No,
Okay.
that's it. Thank
Okay.
you.
I just wanted to make sure. Yeah, certainly interrupt me as you all have questions. I'll be happy to answer any of the questions, and then I only have a few more slides here, but we can kind of go into the live site a little bit and look at a few things there as well. So this middle area that I highlighted, your profits, your assets, and debt, what I really like to see are these metrics that I always say marry the income statement or your P&L with your balance sheet. It really tells a lot about the overall health of the company, because at the end of the day, this formula that I'm about to show you culminates with return on net worth, or your return on investment, or return on equity. It's all kind of one and the same: return on net worth, return on equity, return on investment, ROI. They're all kind of the same thing in terms of the amount of money you're investing and what's the return for it. What's that profitability metric on that overall amount that you've invested? And as we look at that, it basically boils down to these five metrics. And this is it's just algebra at the end of the day, but DuPont, the DuPont company, actually I guess technically pioneered this, but at the end of the day, it's math. So you'll hear it sometimes if you ever look it up. It's called the DuPont profit model. But anyhow, it's profit before taxes, or either your operating profit or your net profit, or your bottom line net income before taxes, divided by your total revenue. So that's your percentage profit margin. Then your asset turnover is your total revenue divided by your total assets. Your total assets being your inventory, if you own the store, if you have made investments in computer equipment or point of sale equipment, any of your shelving and improvement, or any leasehold improvements, those kind of things, all are kind of those things that go into your total assets. So this asset turnover is giving you an idea of what is the revenue being generated by those underlying assets. And so if we take that algebra, as I was referring to, you're canceling out your total revenue on both sides. That gives us a return on assets, which is the profit that those assets are generating. Giving us that, to me, I feel like that's the one of the single best metrics you can look at to see your real overall health, financial performance. It ties everything together, because it's taking the assets that you have in the business and what's the profit that those assets are generating. The next thing, if you look at leverage, this is kind of a hybrid leverage metric, with total assets on the top and how much of those assets are being financed by the equity that you've invested in your business. And if you take the algebra one more step, where the total assets, the denominator and numerators cancel out, you end up with that return on net worth or your return on equity, return on investment, the profit that you're generating from the overall amount that you've invested in your business. And then I like to include this slide just to so it's kind of obvious how the math works and how the various items cancel each other out and to culminate with your return on investment figure there. So again, continuing down the 5 key areas that we like to focus on is the last one being our people, which is often our most critical and most important asset in the success of our organization. So total personnel expense as a percentage of sales is probably one of the most important metrics because it does sort of normalize things in terms of taking the personnel dollars as a percentage of the sales dollars. If we just look at some of these other metrics that I will look at here on the next couple of slides where we're looking at total dollars, they can be impacted by inflation. So you just want to keep that in mind. So like as I was mentioning, revenues per employee. So if you're looking at revenue per employee, in particular, this does give you sort of at least a benchmark to compare yourself against. But if we were to look at this over the last 20 years, I suspect that these numbers are probably significantly higher than even 4 years ago, in all likelihood, just because of some of that inflationary adjustment that we had in particularly 2022 and to a lesser extent 2023 as we started to see a little bit of that disinflationary environment hit late in the year. Our payroll expense per employee, again, it's a helpful number just to kind of have a general idea of how many many payroll dollars per employee are going out, and just to kind of gauge your operations to others that are similarly sized to you. But it's still a very good metric. But again, looking at it in a historical lens, you do want to have kind of that cautionary glance at it in terms of inflation. So the action steps, kind of as we're wrapping up here, is just pick some key measures. What we like to tell people, we went through those 5 pillars, if you will, is pick out 1 or 2 of those metrics and just keep tracking it throughout the year, comparing your firm with others that are of similar type and size. A lot of this stuff, comparing your firm versus the profit leaders, a lot of this is already being built in and being prepared for you as a participant in ABACUS each year, and certainly getting in that habit of continually participating year after year after year. You do have kind of a library, if you will, of in your portal to be able to change back and forth from year to year and see kind of how you were comparing or performing against the rest of the industry. And the one thing I do like to emphasize that is that last point there, that there are going to be variances. There are going to be things that are where you're outperforming or performing or underperforming the rest of the industry. And it's not necessarily good or bad, even though some of the report card metrics were giving you a grade relative to the rest of the participants. But the most important thing is just to understand why. Okay, why might I be a little bit different here versus the rest of the industry? And certainly as you're going through these things, if you have questions like that and you want to ask those types of questions, we're here for you. Don't hesitate to reach out to us. We'd be happy to help walk through those kind of questions that you might have. Obviously, your accountants are probably going to have the knowledge to be able to help you through that as well. But we're always a resource here as well. ratios to regularly monitor. Many of these are already on your report card. I've added a few others. The ones with an asterisk by them currently are not in the current abacus, but they're worth at least tracking. In particular, forecasted sales growth. The one thing that they're being kind of getting an idea of developing your own sort of internal forecasting, and you all likely have a lot of historical sales data on your own. I would suggest tracking that over on a monthly basis. Even if you don't feel like you can make a great forecast on your own, even letting Excel do some of those forecasting things can help, and kind of see, okay, how are my actual sales varying from the forecasts that I'm thinking are going to happen. It will help you kind of gauge and get an idea of your cash flow positions and your cash positions for future months. That's something that I would certainly recommend tracking on a monthly basis. Some of these other ones, again, the current ratio is a critical one, just to kind of keep an eye on it, at least I would say probably a quarterly basis, just to make sure that there isn't any kind of cash crunch that you're not foreseeing. And then the rest of these four down here are the ones that we covered here today, that you'll likely need to reach out to your accountant for some of that information, largely getting some of the information off of your balance sheet as well, to go with your basically just your top line sales and your bottom line profits, and those are pretty easy to calculate. So again, just like to provide these, as I mentioned, the action steps should be to have that continual tracking of your performance, your business, keeping track of those sort of things. So my contact information is here. As I mentioned, it's not always easy for people that want to ask questions sometimes in this kind of a setting, but if you do have any questions after the fact, don't hesitate to reach out. We'd be happy to help. PK, do you want to jump in? Do you want me to jump into the actual site itself a little bit?
Yes, but just
Okay.
let me add two things on there just
Yeah.
to make sure. So cost of inventory turnover. It is the way inventory turnover is measured here is cost of books sold divided by inventory. Greg, correct me if I'm wrong. Which sometimes is slightly different in the book industry, but both methods are, some people have been calculating sales over inventory. Both methods are good, but for the purpose of this survey, we have calculated cost of goods sold over inventory. That's one of the things. And second thing is, although I do think balance sheet things were very important in order to reduce the time it took, we took some of those things out, but we plan to put some of the things back again and maybe replace it with a couple of other things that we have an adequate survey on now, just to make sure that those ratios are also calculated. But it is very important to talk to your accountant about those ratios.
Yeah, and the cost of goods sold versus sales, that's pretty common. It's pretty much just about every industry uses cost of goods sold that we cover, cost of goods sold divided by average inventory to get their inventory turns. I will say it is much more prevalent in the retail industries in general to look at sales to inventory is kind of the go-to for their inventory turns. And there's pros and cons of each. I don't want to completely nerd out on the pros and cons. But yeah.
And Carol, we have not decided on 2024 questionnaire yet. I will reach out to you for suggestions. So I every year I usually have, I think you've been there before. Every year I have a task force um, of people, group of stores that, you know, tell me what they think they're missing and what they think they would like to add for next year. For example, accounts payable was something new. Average inventory um, per square feet was another thing that we added in
Mhm.
their subscription club, just to see how, what things you could do to add to their sales and bottom line. So there are a few things we added, but we look at it every year and take your suggestions. So I will reach out. Thanks. Yes. Unless anyone else has questions, we can go to the website next.
Yeah. So yeah, in terms of when you log into the site, this is the page you'll land on. We have the industry download for the industry report. We have the customized report, and this is PK's account. This is just a completely fictitious company, so um, there we're not sharing any individual data here. So, but the first thing I wanted to do was just download the Excel data tables. Um, just to show you a little bit of what I mentioned in terms of the some of the additional data aggregation categories that are not necessarily in the benchmarking report itself, the PDF report, but I still feel are very useful and very helpful as you evaluate your operations. Let me see if I can get this to open. So again, we've got the profitability, least profitable group, the grouping where we group the lowest 25%, the middle 50% for middle profits, and then the most profitable are those that were the top 25% in terms of profitability, which it's helpful to kind of measure those metrics and against those categories. We have some other smaller groupings of by sales volume and some more granular groupings by sales volume as well. Um, Primary market size in which you're operating can often be helpful to give you a better gauge of whether you're operating in maybe a more suburban or rural environment versus an urban environment. Sometimes it's a little better to compare yourself to those groupings. Also, the square footage of your store as well provides some additional comparison levels that we think are extremely useful. Um, the size by number of full-time equivalent employees is another one. We do some analysis based on the bookshop .org affiliations. We also have the regional analysis, um, type of bookstore, type of location. The new things I wanted to point out was where we bucketed the data results by the state minimum wage rates and the living wage rates, and also living wage gap. We did some analysis there, and also whether you're doing cash basis or accrual basis accounting. Um, but those are certainly some helpful things that I wanted to at least point out and touch on as we were going through the results here today, just to make sure everyone is aware of the different the additional data comparisons that you can have access to. And then additionally, just kind of going into the live report card. Um, as I mentioned, it's going to, if you are a participant that's participated multiple years, you can toggle in and out of the various years in which you participated. In terms of your comparison groups, you can pretty much pick any of the data comparison groups that we were just walking through. For instance, if we were looking at minimum wage rates over $14 an hour, I could compare myself against other companies that are in an area where their state minimum wage rates are over $14 an hour, and look at how that comparison group, how you compare against those. So in this case, this doing very well, as you can see across these various key metrics. But if we change that to, let's say, the most profitable, it'll likely show a much different story. So we can kind of get an idea of, okay, where are some of the areas that we need to at least investigate further.
I actually have that Sharpie.
Other than that, I don't have a whole, I guess the searchable results I could touch on as well, PK. That's where I was mentioning earlier, where you can actually look at multiple filters to be able to look at the results, let's say by let's say net sales between 500,000 and 2 million, and also in the, say, Midwest region. And then build the report. And it allows you to aggregate the results to get kind of a little bit more granular with the data and drill down a little bit further into your specific scenario. Yeah, other than that, PK, that's kind of all I planned for in terms of walking through. But if there's anything else that you'd want me to elaborate on, I'd be happy to. Or if there's any other questions, we could certainly open it up for any additional questions or comments or anything you want to talk about.
Yeah, no, this is great. So, for everybody, I would drill down on those searchable results and, start looking at fair and, what's the other one? Bad.
Fair or weak, or
Weak.
and even for that matter, again, if you see areas where you're strong that you weren't necessarily anticipating to be strong, investigate again. That going back to that last slide that I had, that you want to try to learn and understand, why you're performing the way you're performing.
Yeah, and one of the things I would emphasize is, if you can, please use accrual method, because in retail, when you have inventory, it's so easy to get wrong data if you don't have accrual method. Let's say you bought more one year and not the next year, or the timing of the bill when you paid is just not an accurate picture. So if your cash basis accounting and your cost of goods sold looks very good or very weak, do investigate, because that could be another reason the data is skewed. So I would definitely encourage using accrual basis accounting. No? Hey, thank you, Greg.
All right. Yeah,
that was
very
great.
good.
All right. Well, you have a good day.
Thank you for listening to Booked, the bookstore education podcast brought to you by the American Booksellers Association. Don't forget to subscribe to the show on your favorite podcast app. Additional educational resources can always be found on the ABA website at www.bookweb.org. Happy reading!